All right, everybody. Hey, welcome and good evening or good morning, good afternoon, whenever you're watching this, guys, whether you're joining us live here on Zoom and on Facebook or catching the replay on YouTube or our email blasts out there. We are honored to have you guys here as we discuss the future of the commercial and residential real estate markets in Indianapolis, what every real estate investor or occupant of Indianapolis needs to know about what's going on in the market here. So honored to have you guys join us. As always, Scott Carson. As I say, excited to be here, excited to be talking about one of my favorite markets in the country right now. But anyway, for those of you guys that are joining us for the first time, we have, over the past couple of weeks, we've targeted the top 40 cities in the country and are going through them individually one at a time. You can always check out the list of the schedule at NoteNationTop40.com. You can see the schedule and catch the replays there as well. But we have a variety of local and national investors, not only just local to Indianapolis and Indiana, but also investors across the country that love investing in the Hoosier State. We'll discuss the statistics and the numbers, what's going on right now in the market with as relevant, up-to-date information as we have. We'll also talk about the second half outlook. We'll talk about future opportunities, where they lie, and how you can tap into those. But anyway, guys, if you don't know who I am, I'm Scott Carson. I've been known across the country as the Note Guy. I've been an active real estate investor since 2002. Big background in finance, mortgages, the debt market since 2004 is when I really got in, found my groove. Obviously, a couple of years kind of learned things and got rocking and rolling. But I've purchased over $500 million in debt. That's thousands of deals from banks and institutions across the country. And I'm the CEO of WeCloseNotes.com. So honored to have you guys joining us and watching this out of your time. I've been working and teaching real estate investors how to market, how to tap into deals since 2004. I am the host of the podcast, The Note Closer Show. Just celebrated our 615th episode today, just under 3 years. And you can always listen to that anywhere that you listen to your podcast. We're just everywhere you can find. But I invest all across the country, and I call Austin, Texas home. So a little about me, guys. But people often ask, why are we doing what we're doing? And my biggest goal, our mission as a company, is to help investors to accomplish their goals and dreams and increase their wealth through debt investing. That's one of the biggest things that we see. We've built an expertise with over a 12-year track record of buying distressed debt from banks and hedge funds, and really believe it's an opportunity out there to help some people. So why am I doing this, guys and gals? Well, because I love helping investors just like you get their feet wet. I had a great conversation with a guy out of Pensacola a few minutes ago talking about his market, what he's looking to trying to do. I love helping people solve problems. God knows we have enough problems out there. A lot of people are struggling right now. Our investors are struggling to find where they can invest in, what strategies are working, what does the future hold for them. And I love helping people do that. But I also believe that this is what's going on right now, has been going on for the last 4 to 5 months, is a huge opportunity going forward for you to change and really increase your wealth dramatically by really doing some great things out there. So I'm a little empathetic to people struggling, because I was once a distressed borrower myself going back to 2003, 2004. I faced myself being in the foreclosure process and was able to work my way out of a bad situation and save my assets. So I have been ups and downs, and I will tell you this, there's nothing greater out there than helping someone overcome an obstacle or achieve a goal or dream that they thought was once impossible. I think we've all been down there, ups and downs. A lot of people, the dream of home ownership was a great thing, but right now it's really struggling for a lot of people. And our goal over the next 12 months is to really help educate and help 1,000 investors tap into this debt market, what's going on right now over the next 12 months. 1,000 people. I know we can do it. We are on our way to doing it. And we welcome you guys to be a part of it. But anyway, let's talk about where are the opportunities. What kind of asset classes can you find? And I'll tell you right, the opportunities are literally everywhere, ladies and gentlemen. Everywhere that you look, no matter what type of asset class you're looking at, whether it's self-storage, whether it's apartment buildings, whether it's single-family homes, you're looking for mobile home parks, which are hot, office building, obviously they got a lot of that out there, or it's like hotels, motels. There are opportunities in just about every asset class out there, wherever you look. You just got to know where to look. And the beautiful things that I love about the debt investing side of things, about investing in a mortgage that I'll get to a little bit, is the fact is that the bank doesn't care what color or skin you are, how young or how old you are. They don't care if you're a business owner or you've failed at business before in the past. If you're willing to put some work in and be coachable, this is the opportunity to really change the outcome of where you're wanting to go. And I promise you that, because it's just the banks right now, and they may not be saying it, you may not hear a lot about it, but here in the next 60 to 90 days, you're going to start seeing a lot more banks looking to move a lot of stuff and get it off their books. And like I said, all the bank cares about is can you fund, and do you have a team that surrounds you to help you out with some of the things? And it's not anything difficult. We'll talk about that there, but literally it is an opportunity out there, guys. And we all have different goals and dreams, and we're constantly adjusting things. Obviously, 2020 has been an interesting year. If you've got some goals set for this year, maybe recalibrating, but I don't care what your goal is. Maybe it's to retire yourself and sit on the beach drinking pina coladas or margaritas, which is great. Maybe it's to actually send your spouse home so that he or she can do something that they enjoy doing. Maybe it's to put your kids through college or help them graduate. We all know that's a little bit important. I don't care what it is. Maybe it's to retire your parents because they're getting older. Maybe they don't have a retirement plan in place. Maybe it's you want to travel more with your best friend or your spouse or your kids. Maybe it's just you want to upsize your house. Maybe you want to look for an opportunity to increase your wealth. We all know one thing. It's possible. And two, it takes cash to get this done. It takes capital. And we'll talk about some of the opportunities tonight to make some of that stuff happen. And I don't care. It doesn't need to be your cash. You don't need your own credit or anything like that. Don't need credit to tap into the amount of deals that we'll be getting into tonight. So, but let's first, what do the national numbers say? Where is everything at in the United States as of this moment? We expect numbers, fresh numbers to come out in a variety of things, but here's where they're at as of right now. We have an 11.1% unemployment rate through June of 2020. That number may increase. Number may decrease in July. It's going to vary from state to state. There are currently 40 million plus people collecting unemployment of some sort. 52% of small businesses are expected to fail this year, if not more. The scary thing is that before all this happened, 1 out of 10 homeowners were already struggling to stay current, ladies and gentlemen. Most people don't realize that. Before COVID hit, 1 out of 10 were already 30 days behind on their mortgage. Currently, right now, as we sit, the national mortgage default rate is at 7.76. That means 1 out of basically 12 borrowers is 30 days or late on their mortgage, 30 or more. 90 or more, not 30. 3 months, 90 days or greater default on their mortgage. That's a scary thing. We'll probably see that number increase over time. If people aren't working and there's no jobs there for them, the government can bail them out a little bit, but they're going to pick either A, do I get paid for the power or do I pay my mortgage? Well, I think I'm just going to pay the power and pay for food on my table. Currently, that number is roughly equates to about 4.1 million Americans are currently in default. Homeowners are in default. Now, if you compare that to what our past was, and that's what a lot of people are doing, that's why my spidey sense, I guess you could say, is kind of going a little crazier the last few months. If you look back at 2008 and 9, when the Great Recession hit, it took us 18 months to hit 1.6 million defaults in 2008. Okay? 18 months. Now, we are 2.5 times that in less than 6 months of this. So, yes, I think we're going to see bigger issues as we go further down this pipeline. The government can't keep printing money, and what's happened is the government's enabled banks to basically kick the can down the road, pretend and extend a little bit, see what's going on. So, we know there's all sorts of defaults across the board. Doesn't matter the asset class type, whether it's your non-prime loans, which is the subprime. Yes, I've been back. I saw a big increase in delinquencies, whether it's your prime loans, your A-paper, your reperforming loans, or your whole prime loan delinquencies, all across the board are in default. They are bracing, the lenders and the banks are bracing for us to see roughly 15 million mortgage defaults here over the next 12 to 24 months. Now, we're probably not going to see that number immediately. It's going to take some time. Like I said, we're roughly about 4 million. That number could roughly be closer to 8 million when the new numbers come out from the different FDIC and the core reports of the banks. It's being interesting to see. I will tell you this right now, it is going to get ugly. Now, if you look at the Housing Hardship Index, what this is a great kind of a index that's been put together by one of the bigger hedge funds by tapping into ADAM data, the Mortgage Bankers Association across the country. And if you look at how Indiana is facing, because I know that's one of you, obviously, if you're living there or investing there, you want to know. Okay. Now it's not quite one of the worst. It is also not one of the better. It's kind of in the middle. Oh, Texas. I'm sorry, this is not right. It's not. It's actually, sorry, I should say Indiana. But the unemployment rate for Indiana is at 11.2. The delinquency rate is at 7.27, which is actually it's better than the national average of 7.6, right? So the unemployment's a little bit higher, the delinquency rate is a little bit less, which is a good thing for Indiana homeowners, okay? And you basically rank 17 nationally. So that's actually better than, what is it, Texas? Your Texas is actually ranked 19th. But that's a good thing because you're in the better half, I would say, for the most part. But it can vary on a city-by-city basis in writings, but that's the state as a whole. Now, you're looking at Indianapolis here, the labor force-wise, as a statewide Indiana, like I said, 11.2 as far as June. Don't have July's numbers, are not released yet from the Bureau of Labor Statistics. And you compare Indianapolis to Indiana, all right? June numbers, Indy was a little bit better than the state, 10.6 in Indianapolis versus 11.2 for Indiana as a whole. And you can see the spike, Indiana spiked at 17.5% in April, came down a bit in May, came down a bit in June. I think we'll probably see that number come down a little bit more for July's number, somewhere probably in the middle tens. Now, if you look here, April, it's 13.3. It was a big spike for Indianapolis. It's come down a little bit. It actually went back up in June, where it dropped in May. So it's hard to tell what Indianapolis is going to see. It's just such a mixture of different employment strategies, okay? So let's look at what the foreclosure numbers are doing for us here. Okay, foreclosure-wise, you see that it's predominantly that first-time home buyer, 200 grand or less for the most part. 100 to 200 and below that is where the huge amount of the biggest defaults are seen there in Indianapolis, okay? Now, looking at the property of the year built, it's kind of all across the board equally, where it's the less than, built in 1950 or older are the ones that have the biggest amount of defaults, some of the older neighborhoods, and then, the 1950s, and then also turn of the decade, 90 to 2000 basically is another bump there. So it's kind of all across the board where it's at. Now, if you're looking at the market trends, specific zip codes, Indianapolis as a whole, the city has basically one foreclosure for every 5,800 homes, which is not bad. Really not bad. It's better than some states. If you look at the top 5 zip codes, the 46228 zip code leads the city as one in every 2,000 or 2,100, I guess should be a better statement to say, homes. 46208 is one in basically every 3,000 homes. So those are the worst 2 zip codes to take a look at there as far as the state is where you're seeing the most amount of foreclosures, defaults out there. Now, looking across the board for the entire city, obviously pre-foreclosures are the same because we've been at a delay. The auctions, basically zero, has been stopped. Bank-owned has went down a little bit for the most part. We look at, you can see the trends there is basically everything got stopped in February. A couple things drug over with pre-foreclosures in March, but it's basically been nothing here for the pre-foreclosures, and the bank stuff. Auctions have popped up a little bit because you can start foreclosing now with for issues that are not COVID related, okay? And you can see the numbers dropped off there, April, May, June, it spiked back up because they're starting to foreclose on your investment properties or you were already late prior to COVID kicking in, okay? Now, Black Knight is a huge fund out there that tracks a lot of stuff. We've seen 50% increases in defaults back-to-back months. May and June, definitely you'll probably see more of that. You look at that, we're basically at the 7.76%, basically a 20% month-over-month change on average. Currently 4.1 millions that are 30 days or more late, but not in foreclosure. That's why I say it's going to get a little bit worse because we've got an initial 4.1 in default. We'll probably see another 4.1, 4.2 that haven't even hit that default strategy basis based on the quarter yet. Okay. Now, the nice thing is that Indiana is in the top 5 states by 6-month improvements. Actually gone up quite a bit better, 34% increase in less defaults. That's a good thing for Indiana. People are going back to work and starting to pay their mortgage back on time. How's that going to work as things shut back down for writing things? Now, Indiana was one of those states. This is kind of a heat map of the different states that did different things during this COVID. And the dark green is basically current statewide moratoriums. And as of June 24th, Governor Eric Holcomb extended his prohibition on evictions proceedings through July 31st Okay, the prohibition only applies to eviction proceedings related to the non-payment of rent. Now, looking at that, he's going to let this expire, though. Moratorium on Indiana evictions and foreclosures will expire August 14th. Okay, now it's August 10th when we're doing this live. So here, this Friday, is he going to let it expire, which he's talking about doing, because this article came out just a couple of days ago, or will he, depending on the numbers, extend it? Who knows? The nice thing is they did do the current statewide. Maybe he will kick it down like other governors are doing and make it more of a citywide or countywide. We've seen that actually happen in Texas, where, yeah, the governor can say one thing, but your specific cities could do specific things as well. Now, we are starting to see a gradual return of foreclosure auctions by state. This is through July 11th. You can see Indiana was basically up to about 5%. That's why you start to see a bit of an increase in auctions taking place. So things are starting to get back to normal, or trying to get back to normal for the most part. Now, we all know that this, with the non-payments, the defaults, we're expecting, obviously, Indianans and a lot of people are worried, are we going to see a big decrease in property value as mortgages become defaulted? Now, it's a hit or miss kind of thing. A lot of people have some equity in their house because the property's increased up. But if you start seeing foreclosures, that equity is going to start decreasing, as we all know foreclosures can affect the local market in a variety of ways. So depending on what type of mortgage is in default will vary on the default rate a lot of times. So this kind of shows you that basically you have the FHA, you have VA, you have conventional loans and all loans. Well, the FHA loans, your first-time home buyers that are basically only required to put 3.5% down, which for many banks, many lenders were donating the 3.5% down and even donating closing costs, Bank of America being one of those. They've got a big default rate, 9.69. This is your most impacted borrower who's basically got a loan in the last 12 to 24 months. If they're now requiring on their budget to include overtime, extra hours, but now they're laid off and they don't have a lot of the extra savings because they basically need to get everything to get into the house to get it, that's where you see almost a 10% default rate. I expect that number to probably climb a little bit. Next highest is going to be your VA loans. People have been laid off work. All the loans are roughly a 4.36% default rate. And then your conventional loans are at 3.16 default rates out of all of them, okay? So it'll be interesting what the new numbers come out for that. We all know forbearance agreements are slowly retreating, being added again. It's been an up and down battle on a state-by-state, city-by-city basis in a lot of cases. Right now, they expect us that we roughly have somewhere between 4.1 and 4.6 million borrowers in forbearance agreements, with the most being the FHAs, roughly about 1.9. Total loans altogether, though, is at 4.6. Fannie is the highest thing. I'm sorry, Fannie was the highest, not FHA. Fannie Freddie at roughly the 2 million mark, and then all added up to there. So, yeah, a lot of people are playing with the forbearance agreements. People are staying it. People are coming off as they go back to work or getting back on it as they're getting laid off. Just depends on the numbers. Now, does this mean good news or bad news? Is this a good or bad thing when it comes to Indiana? Now, Indiana has a lower default rate slightly versus the national average, okay? It does have a longer foreclosure time frames in some of the other states, and it's a judicial foreclosure. It can take you roughly, you've got an FHA loan, biggest contributor of those in default, that's a 540-day process to foreclose, okay? Now, when you add in the backlog of forbearance agreements that are going to drag this out here, plus the longer FHA timeframe to you're probably not going to see foreclosures hit the actual open market, the auction market, for 12 to 18 to 24 months. All right, so to all of you real estate investors, I've talked to realtors in Indianapolis, and oh yeah, people are like, oh yeah, I'm ready for this REO foreclosure. I'm like, well, I wouldn't sit down around holding your breath, because it's going to take a while, okay? It'll take a while before you have access to, whether you're the realtor or you're a real estate investor looking to add foreclosure to your properties. It's going to be some time. You hopefully not sit around holding your breath waiting for this, because you're going to definitely pass out on that. So let's talk about commercial deals. What about the commercial debt out there facing the country? We all know that for rent signs are going up, boarded up properties are taking places, people are protecting themselves, restaurants are going out of business, retail space is vacant, office space is basically being obviously very hit hard. We talk about big box stores going out of business, record filings across the country on companies. How's that going to affect us as investors? Now, I've been saying for a while that the commercial space has been overvalued. You can look back stuff I was saying 18 months ago. I was like, I think commercials hit its peak. I would be very uneasy. Luckily for me, the people that I was taking advice from, Wall Street was saying the same thing a lot of times. A lot of the bigger investors out there pulled capital out of the markets to hold to be ready for something exactly what's happened now over the last few months. Now, when you look at the asset class and the commercial side, this is from July's. August's number's not out yet, but you can see the delinquency stats by property type. Obviously, hotels, motels, lodgings, the record there over 27% default rates through June. Our retails, as of June, was saying it's over right at 15%. It's probably closer to 22% now. Like I said, others, that includes restaurants, some of your mixed-use stuff. It's going to get ugly out there in the commercial side of things. And they're a lending class that's not going to be bailed out by the government, okay? There's no government-backed Ginnie, Freddie, FHA commercial loans. They're going to be hit hard, and you're going to see some of the difficulties. Now, if you're looking at the top U.S. metropolitan areas, you see some big stuff there. You know, Minneapolis at $2 billion, Chicago $2 billion, Cleveland $550. Obviously, Indiana is somewhere in between that Cleveland number and the Chicago numbers out there. Philadelphia's right at $1 million. Sorry, just under $1 billion. Now, what's been the biggest impact in Indianapolis has been the hotels. Serious delinquencies taking place in the Indy market where people are being shut down. Rates are being cut dramatically, trying to say something. But a lot of these hotels, they're expecting them not to recover for a variety of reasons, okay? You look at the Crown Plaza, okay? The Hyatt Regency, you know, these are stuff that's in very serious delinquencies that are already being sent to special servicing, trying to work it out. Doesn't mean you can't pick up some deals if you're an investor. You just have to expect like, hey, this is the low-hanging fruit. If you've ever want to be in the hotel space or looking at some of the stuff, there's some opportunities here to take you to here. Now, looking at some of the default numbers across the board here, 1 in 4 hotel loans in default, we know about this. 1 in 5 in retail. They're expecting office vacancy to increase to roughly 20% nationwide, down from basically being at 95. All right, and that number to get worse in the next year. Rent rates, vacancy rates for roughly retail and restaurant space, 15% to 20% or more by year end, if not currently there right now. So you as a property owner, you have the choice. Well, do I continue to allow my tenants not to pay me and then evict them, or do I try to work something out with them, or do I beg forgiveness from the bank and see if they can't work with me? It just varies on a bank by bank, asset by asset level right now. You're expecting rent rates to fall by another 10.5% by year end, and another 4 to 5 moving into 2021. Now, what does that mean for you? It means if you're going to be looking at commercial assets, you have to look roughly at the tenant in place. You know, that's the beautiful thing in the note business. We do get access to a lot of times the financials of the previous bank look at, but you have to look at rents and say, okay, if it's $1,000 a month at the beginning of 2021, it's probably more $800 a month. Probably not a 95% occupied. It's probably more than 80% occupied because of different things. So you've got to start looking into that. How does that affect us? Well, it affects the banks and the owners more so, because when you start seeing vacancies increase or non-payment or rent starting to drop, that starts dropping the values of the property, the NOIs, the cap rates, and that affects people in a very ugly thing. You're going to see this through next year. It's going to take probably 3 years, they say, 3 to 4 years before we see the commercial market rebound to where it was in 2021. I'm sorry, where it was in 2019 at the end, okay? Now, the thing you got to keep in mind, who's financing this stuff? Where can you find these deals? On the commercial side of space, when you look back 10 years ago, 70% of that stuff was roughly from the commercial mortgage-backed security business, big guys on Wall Street that were putting this stuff together, offering money up relatively cheap for the bigger firms. Now, going back and then what's going on now, it's not been just the CMBS guys. It's been a lot of your local banks. Your banks have gotten greedy. They want to get into this, especially the last 2 years. You look at the distressed loans and the stress test, 53% of the defaulted loans, distressed loans right now, were financed by the banks. Okay? CMBS guys were smart enough to get out, get some of that sort of refunds, but the banks are now, what's going to be clogging up their arteries is some nasty stuff. Now, they're not financing 100% like they would in residential a lot of times. What they are doing is lending stuff at 69, 67. They're trying to stay below 70% of value, okay? They finance something, oh, you would think that the borrowers would be great, 30% equity. They either brought some money to the table or cash, right? Not necessarily. When cap rates drop or rents drop, that drops the value of the property. All right, your incomes, net operating incomes drop dramatically. It drops the value fast. So now, if the value, say, was $1 million, and a bank financed 700 grand, well, now the value dropped by 20% to 80 or 800,000, and the bank financed 700. They don't like being in that LTV basis. They want to see somebody, the borrower, to come in with bring cash to write that loan down to 70% of 800 grand, which would be 560. So they're going to ask the borrower on that situation to bring 140 grand to the table. And most of these borrowers don't have that. Okay. And you see they're going to have it across the board. So the banks are going to start foreclosing. Yeah, they may give them a pretend and extend mentality for 6 months, trying to work with them. But I guarantee you, look at what's happened now and look at what's going to go rolling into the fourth quarter here, just basically about 60 days away. The banks have had basically 6 months to evaluate their portfolio on the residential and the commercial side. They're going to know who's, as a single family resident borrower, who's been paying, who's been smart with their credit. And they're also going to know, hey, what commercial assets are going to be the biggest in trouble? What's the asset class, the hotels in our books, the retail facilities we've lending on? What are the other commercial properties that have dropped in value because of lack of payments? And they'll be looking, to either cash, get some cash in, or cash out of these deals. And that's, what do you do? Well, that's why you as an investor would step in and start providing capital to buy out some of these bad loans, or work with the current borrowers to try to reposition the property in some sort of fashion. Now, how would you reposition the property? There's some different things you can do. We'll talk about that in a second. But the banks are expecting to lose roughly close to $50 billion on commercial real estate loans. $50 billion, okay? Recently, Bank of America set aside billions for soured loans. This came out just a couple weeks ago. They're expecting to be a part, Bank of America, Wells Fargo, Chase, Citi, all the bigger banks are literally billions of dollars they're expected to lose from these soured loans. And Bank of America's part is just 5.1 billion is what they've got. That's just what their first estimate is as far as soured loans. Of course, I think it's going to be bigger than that, but that's a big chunk of the $50 billion. Is there 1/10 of the either the problem or part of the solution if you know how to attack into this thing? That's most of the commercial stuff. Yes, you have some residential stuff. There's only another residential side yet. How long will the government continue to bail out the government-backed loans? Okay, Ginnie, Fannie, FHA. Hey, those will probably have 6 months, if not another 6-month extension of the forbearance agreement. But it doesn't mean investor loans are covered in that. So opportunity is the way I look at that. Okay, so where are the opportunities? Is it going to be in the foreclosures and REO market? Not if you want deals anytime this next 12 or 24 months. Is it in the fix and flip side? No, you don't want to be in the fix and flip business because not only is financing kind of drying up a little bit in other parts, especially those that are hit, but your values are dropping. Your after repair values are going down 5, 10, 15, 20%. Is it in the rental market? I would not want to be in the rental space, even though a lot of apartments have been relatively on time, 85, 90% of payments being made. Student housing has been hit very hard. And it's interesting to see what happens as the universities decide what's going to happen. Are they going to allow kids back? Or is football season going to be canceled? That's I called that 60 days ago. Like, we're not going to have any college football or professional football for the most part. Just don't see it happening. So the real opportunities is buying the debt in the debt game these days of buying the debt, becoming the bank, but buying that debt at huge discounts and then having the flexibility to really work it out with the homeowners. Homeowners on the residential, which we'll probably see in the fourth quarter here because the banks have had 60 days to evaluate, like I said. But the commercial side, we're already starting to see commercial deals. I have guys that I'm talking to on Wall Street in California that said they're already seeing more deals now, sweet deals on assets that they hadn't seen in 24 to 36 months. Some phenomenal numbers, the commercial notes that are immediate or the residential notes. They expect to see more in the fourth quarter and beyond that, maybe more of a trickle, whereas the gate is open on the commercial deal side of things. Now, repositioning an asset is going to be one of the most valuable things you can do. Your neighbor to the west in Illinois, here, Arlington, Illinois, this borrower and owner of this hotel got smart. He repositioned and pivoted the asset to turn it into apartments. Newly built hotel, not leasing, not renting a nightly thing, turned it into an apartment complex and did a really good job with it. Our buddy Garrison Gilbert out of Maryland is doing the same thing in Pennsylvania to a 55-unit hotel. That's the thing, ladies and gentlemen. We're not talking 200, 300 unit hotels, like, unless you want to buy that big. I mean, you look at a 1,300 unit hotel in New York City, across from Central Park, 1,300 room hotel, $260 million mortgage on that being sold for less than 20 cents on the dollar. True story. There's an article written about it. It's been in default for over 24 months, and the bank is looking to finally sell it and just get something. Get $50 million on a $260 million loan. Hey, opportunities there. Now, also, if you look at the office space, you could be like this guy in Denver, where he took his 107 unit office building, not the whole building, 110 units office, like not mixed use, but executive office space, like a Regis or stuff like that. And he converted it, not a lot of need for office space. He converted it to self-storage facility. Yes, and 7 covered parking spots to that. Brilliant in downtown Denver, where it was needed. So he basically got leased up very quickly as other companies started having to store their spot. They're not working from the office anymore. They're going to need a spot to store their stuff to hold on to it for a while. Brilliant strategy. We were really excited about this asset here too. We've actually got a bid in on it. We just came across this. So what are the biggest opportunities? It's not going to be the big 5 million, 10 million plus deals. The biggest overlooked asset that Wall Street really doesn't want to tap into is not because they don't like the asset class, is that they don't like the loan amounts. They don't want to deal with anything really below $5 million in value right now. And that's a huge amount. That sub $5 million value, that $2.5 million loan amount or less has been what's been financed. It's clogging up the bank's arteries worse than their fat burger, okay? It's going to give the banks a heart attack. And that's where you and I, and investors like us, can come in, pick up this debt at a discount, oftentimes get the bank willing to carry a big chunk of it from the non-performing side to the performing side if we take the asset over, and then work out flexible agreements with the tenants or the borrowers, and then turn it into a variety of either cash flow or asset control and a variety of different things. But this $2.5 million or less market is clogging up banks. We see it all over the place out there right now. And banks have really been getting antsy about starting to move some of the stuff. So let's talk about some of the banks in trouble, because Indiana's got their fair share. We know there's thousands of banks that lend in Indiana, that they are located in Indiana with branches and a variety of things. But if you look at a couple of things, one thing that we look at on a regular basis is the Bauer Financial. You got to realize your FDIC banks, they're going and filing their quarterly reports at the FDIC, okay? Bauer Financial is a service that goes and evaluates those quarterly reports to determine, okay, who's in trouble, and ranks them from a 0 to 5-star rating. 0 being very bad, 5-star being good. But looking at the percentages, because this is all disclosed information, okay? Now, out of the thousands of banks that have offices in there, if you look at those that are based, there are 56 major banks based in Indiana with at least 5 branches or more, okay? There's more banks than that have like 1 branch, but I didn't want to spend my time with those. Those banks that have 5 or more branches, there's 56 of them that are based, they call Indiana home, okay? Combined, they have $430 million in 90-plus defaults, 90-plus day defaults right now, okay? That's on the front end. That was as of June. Well, when they filed this in June, they also disclosed the fact that they have $342 million in 30 to 89-day defaults, okay? Distressed stuff that's already defaulted now. So that's almost $1 billion. What was that? $800 million in distressed debt that's in default, basically at this point now. Now, if you average that across the board, basically it's about 5.37% average of each bank's loans are 90 days plus past due. That's not a good place to be, where 5%, 6% of your loans are in distress. Not good at all. They don't want that, okay? Not good. Now, that's a mixture of residential and commercial assets, okay? Now, if you look at that bundle, $110 million in single-family residential loans is currently in default out of that 430. So 25% roughly is in residential debt default, okay? Now, you look at the 2 biggest contributors. You have Spencer County Bank, has 17% of its entire portfolio in default. Yeah, not good. They're an overachiever, okay, or an over-underachiever. Then you look at First Farmers Bank and Trust. They're also at 70% of their portfolio in default. So those are the 2 biggest banks with the biggest percentage of their portfolio. Those, I would say, is the low-hanging fruit, okay? Low-hanging fruit in Indiana, just from our basically 5 minutes of looking at the Bauer financial report, tells us that out of the 2,000 plus banks out there, we filtered down by Indiana-based, not lending in Indiana, but I mean, not just lending in Indiana, but based in Indiana. That's where your opportunities lie right there. Now, why would you want to buy distressed debt? Well, because the fact is, one, instead of waiting around twiddling your thumbs for 12 to 24 months, you can start buying this debt now versus waiting around for the foreclosure thing. You can buy deals that never end up going to foreclosure because you can step in, buy stuff at a discount, and really work it out in a variety of strategies, okay? It's going to vary on the discount, depending on location, time frame, how big the city is, how little the city is, what else the bank has on its books in default, the value, the condition, the foreclosure time frame, if it's been started, current tenants, what's going on with them. There's a lot of different things that involve it. You can pick this debt up at big discounts, 30 to 70% off of what the old market value or current market value. You always buy off a current market value. So maybe even bigger discounts compared to what is owed on the property. Your strategies can be to do a loan reinstatement, a modification, short sale, short payoff, foreclosure, loan sales, deed and loan cash for keys, take over receivership if they file bankruptcy. A lot of great things that you can do being the bank, because when you buy the debt, you become the bank. You have the same rights that the bankers do. But why would the bank sell it to you? Because they would rather get 30 cents of what they're owed now to go out and leverage that out and let you deal with that. Okay, let you deal with that headache. Well, yeah, okay, fine. I'll take a 70% discount to deal with some of your headaches and turn some lemons into really sweet tasting lemonade. Okay, take over the note and either turn it into a cash flow or a performing note, or if you want to control the property, you can do that, take it over the property and hold it onto your portfolio and manage it that way. Look, if you're getting 80% of your rent, but you picked up the asset at 50 cents on the dollar, that's 160% cash and cash return, basically, compared to what would have been a negative thing, would have been a good thing for you. All right? So other advantages of note investing. Look, I know there's a lot of investors across the country that are going to be watching this, that are doing a variety of things. Look, we don't have direct mail costs in the debt game. All right? I'm not mailing out postcards or yellow letters or bandit signs. I'm not doing any of that stuff because we don't need to. Everything is basically, we're that close to the source. You know, if you can send email blast out, if you can jump on LinkedIn and connect with asset managers, we show you how to do that. Or if you can start dialing for dollars and know what to say, who to talk to, when to say it, and what not to say, you can find deals that are on a regular basis. A bank can send you stuff every quarter, every month, without you just, I got to send out 5,000 more postcards to get one potential deal, or 4% of response rate to get one deal from that one distressed borrower. We got distressed banks. We were closer. We're much further up to the source. So we get stuff. I have banks that send me lists every quarter for the last, 5 years, 10 years in some cases. Not one property, one source who feeds us on a regular basis, okay? And what do they send you? They send you a spreadsheet. It's called a tape. Cherry pick the best deals for your portfolio. No, you don't need to buy the whole tape. Most of the banks are like, just buy something now, please. Now, if you do want to buy in bulk, you should get better pricing because you're taking on more distressed assets. And you're not going to be doing this all yourself. There's servicing companies, there's attorneys. You're not the person to do it all, okay? There are people out there who can help you to do this. Like I said, if you want to focus on residential or commercial assets, a lot of times the banks will have both. All right. Now, you're not going to buy a one-off residential note from Bank of America, Chase, or Citibank. On the residential side, they're going to sell that stuff in big, big pools. But they will sell a lot of that commercial stuff off on a one-off basis. And you don't have to have your own funds, okay? If you go find the deals, I guarantee if you start marketing what you're doing and what kind of deals you have, you'll be able to raise capital from other investors to fund your purchases, okay? And here's the thing, guys and gals. In 2010, we peaked at 15 million homeowners underwater in 2010, 2 years after the start. We're already at 4.1, 5 months in. Do you think we have the chance to get to 15? I think we do. I don't know if we'll hit it, maybe 10 to 12. Okay, 10 to 12 million homeowners. That was meaning us probably 1 to 3 to 5 million commercial assets are in distress out there. It's hard to say right now. But there's opportunity like there's never been. If you want to change some things about your future or where you're at currently, now is the time to start taking advantage out there. Now, those of you are like, well, I don't have a lot of money. I don't have $1 million to buy a property, Scott, or buy a note from a bank. I'm just going to sit here and sit on my hands and suck my thumb. Well, there are investors out there, ladies and gentlemen. To give you a bit of an idea, there's currently $9 trillion in retirement funds sitting out there waiting for somebody to give them a phone call. do some things with in Indianapolis alone. Okay, in Indianapolis alone, there are 18,000 investors with an IRA. There's more than that with a 401k, but there's 18,000 investors with an IRA, individual retirement account right now. Out of that 18,000, there are 12,000 of them that have at least 150 grand or more in their accounts. Yes, 12 grand with 150 grand or more. How many people do you need to talk to or market to? Not postcards, but if I could show you a way to tap into those people, to know exactly where they're at, what they've invested in and stuff like that, would that be valuable to you? Heck yeah, it would. But let's just take it one step further. Say, oh, I'm scared to talk money. I don't want to raise capital. I just want to wholesale. I don't want to be the easiest thing. Great. Then flip your deals to other investors, because in Indianapolis, there are 17,000 plus people that claim on their tax returns to be real estate investors. So go find the deals from the bank and then flip them to other investors. If you don't want to raise the capital, fine, wholesale it out. Make your 1 to 3 to 5, your 5 grand to 100 grand wholesale fee if you need to do that. Or partner up with investors to take it down and stay involved for a piece of the pie. There's a lot of great ways to be making money as note investors out there by taking it out. Now, the question I want to ask you is, do you want to be the banker or the borrower? Most investors are on the borrower side, okay? You want to be the bank. The bank is actually mightier, okay, a lot mightier than the hammer or the sword, okay? And honestly, there was an article out today, I don't think I didn't post this one, but literally there are people socking money away. We saw a 37% increase in savings. A lot of money sitting money on the sidelines. People have been furloughed. People have been laid off, have retirement accounts they need to roll into something. They need somebody to talk to them. They need somebody to go find them a deal. If you know where to find a deal that's sweeter pricing, better pricing, more deal flow, and more opportunities, then I'm going to just buy a fix and flip. No, you guys can become the bank, and the bank always wins, ladies and gentlemen. Here we go. Americans are sitting on record cash savings amid pandemic. Certainly today. The bank always wins. Become the bank. Okay? Buy this debt at a discount. The bank, work out something that makes sense. Raise capital. Talk to the bank. A lot of times, if it's $1 million+ loan, they may even want to carry that paper for you. Move it from the bad side to the good side. Okay? So how do you tap into the tsunami of debt, everybody? Well, look, I've been teaching investors about notes since 2010. I've helped thousands of investors purchase their first non-performing note. We've done thousands in deals, and, you know, whether it was residential, commercial, I cut my teeth in commercial notes to begin with. Still look at this stuff, okay? Looking at some self-storage facilities right now, looking at office space, you know, different parts of the country. I want some good stuff, okay? Whether it's cash flow or asset growth, either or. Maybe you're a real estate investor looking for more rental properties, okay? Look for notes that are in your market or your market you're investing in that you buy the debt on. Either get them reperforming, foreclose, and take the property back and keep it as rental, okay? Or just turn it into cash flow. And you can buy one-offs or in bulk, depending on what the lender has, okay? We can see a lot of people get started buying an asset for like 25 grand. That might buy you a $50,000 asset in a lot of places. That can be a decent property, all the way up to like a $5 million one-off deal, okay? Cheapest note I paid was $7, okay? Biggest asset I bought was $5 million trade on 3 units, okay? Like I said, bank does not care what your credit is. They don't care if you're in forbearance agreement right now. All they care about is can you fund on what you need to fund on with either your own funds or other people's money. They don't care where the money comes from. You don't have to have it yourself. And if you can jump online, send some emails out, reach out to people on LinkedIn, or pick up the phone and dial for dollars from those that have answered an email or answered a response, and follow a script in a step-by-step basis, then you can do this business. This is not difficult. The banks will sell you notes, all right? They definitely will. And I don't care whatever your focus is. We talked about it before. Whether it's single-family homes, apartment complexes, hotels, retail office, self-storage facilities, mobile home parks. I don't care what it is. There's deals in all asset classes, okay? And you can really create some win-win stories, not only for yourself, but for the property owners or the borrowers involved. Just like this lady on this one property in Illinois, Southern Illinois. Been living in a house for 18 years. Been trying to do a loan mod for 4 years. We bought the debt cheap, part of a pool. Saw that she'd been trying to stay in the property, kept the property up, able to negotiate a loan mod with her in roughly about 30 minutes on one phone call. She's paid on time since. It's been a really great deal. We cut off 26 years off her mortgage payments and a ton of interest that we were never going to collect because Her house, she owed on her house a whole lot more than what it's worth because the market dropped and it come back. But it's a win-win. Those are beautiful stories. Maybe you want to pick up a high-end asset on the beach. Hey, there you go. We picked up a couple of these assets directly from the Bank of Arizona on San Diego Beach. Bought the notes, was able to negotiate with the borrower to walk away, and then we turned around and flipped them and sold them. That's the beautiful thing. And if you take a foreclosure and you buy a foreclosure asset, you've got to wait 90 to 120 days to reevaluate the asset. In the note space, you buy debt, you buy the notes cheap enough, there's no disclosure what the sales price was. Sell it off every repair. You don't have that seasoning time frame. It's a beautiful thing. Maybe you're looking for smaller apartment complexes. You're going to see plenty of smaller complexes out there, not the 100 plus, but plenty of smaller complexes all across the country. You know, I bought a note on a 300-unit apartment complex in Indianapolis 10 years ago. Yeah, big discount. Able to turn around and flip it for $100,000 wholesale fee in 24 hours. I could have kept it, but it made more sense to get that $100,000 in 24 hours versus trying a 6-month to 9-month process. Okay. Whatever your focus is, whatever asset classes, or whatever your long-term goals is, you can do it big or you can do it small. And most people start off small and they work up to the big. Okay. As I teach people all the time to do. Look, start off simple. Let's get your systems down, get your goals down, start getting your systems and numbers and activities and vendors down and get rock and roll. Just like our buddy out of Elkhart, Indiana, fellow Hoosier, Gene here. When we met him about 5 years ago, he was working as a hotshot driver for a small company, driving vehicles around, flipping a property here or two in Elkhart, and getting by, but not doing quite as much as he could do. And we spent some time with him, taught him how to do this note business. Fast forward 4 years, he's closed on over 135 assets. He's raised over $13 million in capital that he was stressed out about. And 2019 was an amazing year, and he's even more excited about what's going on in 2020. Isn't it nice to be excited about something versus suffering from dread and doom? Okay. Gene's done an amazing job. We couldn't be more proud of him. All right. You look at Laura Blunk out here. She started off like many real estate investors, going to real estate clubs, trying to wholesale, trying to do some light fix and flips, trying to do some options, running around like a chicken with your head cut off. Okay. How many of you have done that, have gone to 20 million different workshops to add that tool to the tool belt in case you come across that one deal? She learned the note business from us. The time she started to the time that basically end of the first 18 months, she closed on 14 deals in her first 18 months. Was doing really well, raising other people's capital. First 2 deals she bought with her own funds, but everything else has been using other people's money. Now she's getting ready to close on a big deal, 100 plus assets, $4 million trade. She just moved into her dream home on the water in Maryland, left South Austin, just did this, and we couldn't be more pleased for her. She's just done an amazing job. Over 100 deals closed and another 100 on the books to close as well. We're excited about it. Right? And you look at our buddy Keith here. Keith's out of Ohio, just outside of Cincinnati. Worked in city governments. I think he was the mayor of a city there in Ohio, but worked in water treatment building plants, building that and other things. Been an investor doing stuff, enjoying it, kind of semi-retired. Learned the note business from us about 3 years ago and has been just killing it in a tougher time. He's so excited about it. Literally, he sent me an email about a month ago saying, Scott, we made 7 figures in 2019, him and his wife. He goes, I love the note business. I love what you do. I love how you teach. We could not do and made as much as we did without taking your training to understand what's going on. And I love hearing it. I get so excited about when my students succeed. All right. But you don't have to have experience. Okay. You don't have to be a little bit more seasoned to do it. Look, if you've never owned a house or never bought a property or brand new to note investing, hey, you know what? Maybe you need to be like Raphael here out of San Diego, never bought a house, was renting an apartment, wanted to get in the note business. He was a small business owner. He owned a car detailing business, had 15 full-time employees, got in the note business, started learning, took our training in November. First 30 days, bought 2 assets, and another 2 weeks ago, they bought another 3 assets, so 5 total in his first 60 days. First 2 got modified, bringing about 20% cash and cash. The other 2, he's getting ready to double his money by flipping. COVID hit his business hard. Literally, he had to shut down, and if nobody's driving, nobody wants to pay to detail their car or have somebody come over to do it. So he had to let his whole staff go. He's not that stressed about that because the fact is, he's like, Scott, I don't have to worry about that. I may never open my deep business. I may just do it because of the fact I've been enjoying the note business so much. I've learned this. I'm learning it out. I talked to him 2 hours ago back and forth via text message. He was working on a deal. and I send him a form to help him out with stuff. But no experience, no homeowner. He used his funds in the first 2 deals, but he's raised capital, right? 150 grand in capital from just friends and family from talking, and you can do a lot of good stuff. He's not buying in San Diego, but he's buying in other places out there, like Indiana, for one. So, like I said, we get so excited about helping our students out there, and we've got all age classes, all color, sex, whatever. We've helped thousands and thousands and thousands of investors from across the country make a big difference in their investment business, changing their wealth strategy, changing their outline, where they're headed in a variety of fashion. How do they do it? By our training. And we've put together an amazing one-day training that we host on roughly the 3rd Saturday of the month called Note Weekend that I would love to invite you to. If you're one of those out there that might be a little crazy but want to do some good out there, but don't want to spend a lot of money right now because you're a little tight, I get it. That's why we've made Note Weekend a very affordable training program for anybody out there, any budget class, any experience level, to help you learn the note business and dip your feet in the water and see if it's for you, okay? Now, we've got a variety of different things. You know, it's a one-day online via Zoom. It's live, yours truly, mini workshop, going through a 20-page manual with it, going through step by step, a couple of things we cover on there. You live stream it on Saturday. You guys skip it or step away as a family, something, don't worry about it. The replays are included, so you can watch those on Sunday, right? Our students call it the Cliff Notes version of note investing, which I love that state because I used to read a lot of Cliff Notes in college to get me through college. But that's the thing. We cover the high point. You're not going to learn everything about the note business in one day. You're not going to learn about it in 3 days, okay? But you can get a good feeling, a good start, and really sit down with somebody who's closed on thousands of deals who's going to say, hey, do this, don't do this, okay? Do this, don't do that. This is how you do it, step by step, and showing you what to do out there. And we charge only $49. Like normally it's $99. We cut the price in half. We'll run from 10 to 3, 10 to 4, 10 to 6 at night, depending on how long and how many questions people have. And it's just me speaking, not a pitch fest. They don't bring in 20 recorded videos for you to watch. You can watch the replays later on. But on top of me spending 5, 6, 7, 8 hours with you, I also do have about 10 extra hours of video from our vendors, our servicing, our asset protection, a company that helps you get lines of credit, our vendor, our Rolodex of contacts to help you out with it. That's included with that at no additional cost for you guys. You can go to noteweekend.com and get signed up. Like I said, we usually have it the 3rd Saturday of the month out there. Sometimes we'll have it on the 4th Saturday, just depending on what's going on out there as well. So what will we cover at Note Weekend? We cover a variety of things, everybody. The first part of the day is all about how and where to find the note deals. I'll show you how we pull a list of bank asset managers and who's in trouble, like I talked about a little bit earlier. We'll talk about when to contact them, when not to contact them, what to say, what not to say. You got scripts and some sample emails to go along with that. We'll also, the second part of the day, talk about how to get other people to fund your deals, how to find private money, how to get them to fund your deals, all right? How to communicate with them, how not to communicate, things to say and what not to say, all right? We'll talk about the different exit strategies because there's roughly about 10 different exit strategies across the board on the residential and the commercial side. So we'll talk about the different ways to actually make money when you buy notes. What's the good, what's the bad, okay? What do you want to stay away from? What do you want to target, all right? We'll also talk about the vendors and the team that you'll need. You need to have a servicing company. We'll talk about that. You need to have realtors, real estate attorneys in each state. We'll talk about how to find those and how to connect with them, okay? We'll also talk about some different loan trading platforms. There's not an MLS out there, but there are some different websites out there that you can start looking at assets today. Residential and commercial deals you can start looking at today, breaking it out, putting your system in place. If you want to do that, that's the low-hanging fruit there for it. And we'll cover a lot more throughout the day with your questions that you ask as well. But I encourage you all, go to noteweekend.com, all for this for just $49, noteweekend.com. Click on that link. You'll see a red registration link. Click on the register there. It'll take you into a checkout page. Get signed up there. The price should automatically drop from $99 to $49 for you guys. Automatically, I haven't put a code in now. If that's not good enough, I'm going to throw in some more bonuses for you here. Over $1,000 in bonuses for you. Obviously, the class, we throw that in there. Obviously, normally $100. We're discounted down to $49. We have a one-day calling banks training where I'll literally pick up the phone for 4 hours, and you can watch like a fly in the wall as I dial for dollars. I make 50 phone calls in roughly a 4 to 5 hour period. You can see who I'm calling, the conversations, the messages I'm leaving, me getting hung up on, me having back and forth conversations with the asset managers and how I connect with them, not only via email, but via the phone and also on LinkedIn. What do I say? What don't I say? That's normally a $49 training. We throw that in for free, okay? We do that usually about once a month out there for you guys. I talked about the Bauer financial list, the list of over 2,000 banks, their quarterly numbers, the good, the bad, how they rank, how much they have. That's normally roughly about a $400 purchase when you buy it on a quarterly basis, not $100 a quarter, $400 each quarter. We'll throw that in the most recent quarter into your bag of bonuses. That was worth the price of admission if you're serious about distressed deals anyway, okay? How would you like to pull up a state or pull up banks and see exactly what they said they had in default? What do they have coming down the pipeline? It's not going to show you the assets, but the numbers, the percentages, and it's up to you. Oh, yeah, the bank president's name and phone number. How would you like that? That's included in there as well, too. We always also like to do a 30-minute phone call, one-on-one coaching call with our students after the class to help them give them an idea. I charge $1,000 an hour in consulting, so that's a $500 value. Just like the guy I was talking with Alex today. I was talking with Raf, talking with a variety of people. Get on the phone, let's talk. What are you focused on? What do you need help with? And let's get you moving in the right direction, not the wrong aspect, okay? Yes, it's a phone call with me, all right? My cell phone, pick up the phone, get a 30-minute phone call with me. We throw in the replays we talked about. If you've got your spouse or business partner, they're invited as well. That's included. We also got an amazing Facebook group of roughly about 900 students of ours or investors. It's a great place to raise capital. It's a great place to find people to help you with your due diligence. Great place to potentially find investors to sell your deals to when you get them all when you get them sent to you from the banks. Okay, so all this is over $1,000 in bonuses, guys and gals. We include this, no extra cost, stuff like that, all thrown in for roughly $49. And like I said, guys, I would love for you who are watching this either live or in the replays to be a part of the 1,000 people we want to help in the next 12 months. And this is a small price. And if you guys go through the first day, go through the day and say, listen, Scott, this is not for me, no problem. We'll gladly refund back the $49 to you, no questions asked. Don't care. Hey, if it's not for you, I don't want to waste time. I don't want you to waste time and money on something you're not going to be doing. So once again, guys, whatever your goal is, we've all got dreams. We're all looking for ways to accomplish those. Whatever your goal is, whether it's, like I said, you want to sit on the beach drinking piña coladas or margaritas, or you want to spend more time with your spouse, traveling more, or retiring them, or you want to send your kids through college, or you want to retire your parents, or you want to go see travel with your best friends or take your family on vacation, or you just want to upgrade your crib and other toys. This is the plan for you. It's not a get-rich-quick scheme, guys. This is a thing to build wealth, and we know building wealth takes money. And I'll show you how to find the deals, how to find the capital, and how to make money in notes. So like I said, I'd love for you guys to be a part of it. If you go to noteweekend.com, you can get signed up today. You can see the schedule. Get signed up now, and basically by this time tomorrow, you can have the replay link sent to the previous class to start watching now, to start learning instead of having to wait a week or two to join us for the next class. But would love for you guys to be a part of it. Go to noteweekend.com today, and welcome to Note Nation, everybody. Love for you to be a part of it. Are there any questions, comments, concerns? Before we wrap it up, let you get back to your evening, everybody. All right, we'll let you get back to your evening. Thank you for being a part of tonight. Look forward to seeing you guys at Note Weekend very soon.